Hey everyone, it's Adam. I'm going to go over the Federal Reserve meeting today, or just a statement that Chairman Powell made, because I wanted to do another video today because Chairman Powell raised the federal funds rate by 25 basis points. So we're at 5.25% with the Fed funds rate. And I found an article that was real interesting from MarketWatch, and just wanted to go over some data from the Federal Reserve. So I'll bring that up here. And in his statement, a section of the statement I wanted to read because I found it really interesting. Chairman Powell said the worst outcome for everyone, of course, would be not to deal with inflation now and not get it done. Whatever the short-term social costs of getting inflation under control, the longer-term social costs of failing to do so are greater. And the historical record is very, very clear on that. So Chairman Powell is very firm, and he wants to get inflation down. Jeffrey Gundlach was on CNBC today and brought up an interesting point. He didn't think that the Federal Reserve should proceed with another increase today. He actually said that inflation is coming down, which it is, and the headline PCE could go down into the twos fairly soon. So I thought that was interesting because that being the rate they want to, or the percentage of inflation they want to hit based upon their mandate. So there was, in this article from MarketWatch, let's see here. Yeah, this is from Hoisington Investment Management Company. I believe Lacey Hunt owns this company. It's out of Texas, and he or they were quoted as saying negative money growth, increasing fiscal deficit, rising real interest rates, and central banking guidance of higher short-term interest rates are creating a classic credit crunch. So, this was something we heard around the GFC. It's something that happened around the GFC. A contraction of credit for the economy is detrimental. And I just want to bring up this chart here from the Federal Reserve, showing that it is beginning to slightly contract. You can see the last time this happened was back during the Great Financial Crisis in 2008. And then it has just steadily, well, maybe not steadily, but pretty aggressively risen up until today. So that is an interesting perspective by Hoisington. I have to agree with them on that. And here's the Fed funds rate. So as you can see, another similarity to the GFC in 08 is you have, after the dot-com, the Fed funds rate goes down to the 1% range. And then when they start hiking, at that time it was Greenspan who began hiking, goes up here, and then we know what happens in 08, and it is kind of a similar. You have it going down to zero, and then it's coming up to it's right today. It's going to be 5.25%. And another chart that's interesting, because real estate is so important in the United States, such a big aspect of the economy. You can see that the median house price steadily increasing here. I mean, dot-com bubble was a little bit choppy, but it goes up here, and then with the kind of falls and almost in line with the Fed funds rate. And we're seeing that again, where it's starting to really fall off. So it will be interesting to see what happens. I think a credit contraction, as I said, it's going to be detrimental towards the economy. I think things are shaky right now. It'll be interesting to see how things play out. I'll continue to update with the videos, and I really appreciate everyone watching. Hope everyone has a great day.